Hey, everybody. I love these Festival of Trader events. They are so, you can learn so much from them. I was listening in on Jody's presentation. I always learn from her. So I've got a presentation, and this one's actually a little bit different than the ones I usually give, mainly because the market's quite a lot different than it usually is. So let's talk about it. Your blueprint to avoid trading pitfall in today's market. And we're going to talk about harnessing options pre. All right, all right. So I think that I was talking a little bit and I had been muted, but I think I am live now. Hey, I really love these Festival of Trader events. You learn so much. I just was listening in on Jody as I was waiting for my turn, and I picked up so much. Um, your blueprint to avoid trading pitfalls in today's market. My presentation's a lot different than I usually give, and that's because the market's a lot different than I usually than we usually have. So just to let you know, my presentation is not all slides. I'm going to be showing you a lot of my trades, some charts and stuff. So please be ready. And mine usually I don't have much of a pitch. I will talk about something at the end, maybe in the last minute or two, but I want this to be educational for you. So please get ready to take some notes. There's a lot of uncertainty with what's happening in the world right now. That's a no-brainer. What's happening in the markets, if you play it right, can set you up for months, if not years to come. Because you got to remember, money is not created or destroyed in the markets, right? As much as you hear, people's 401ks lost trillions of dollars, blah, 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 from the talking heads out there, right? It simply is moving from one person's hand to another. That's what markets are all about. The key is making sure if you put yourself on the correct side of the transaction, right? So what I did early on, we're talking about in the 90s when I started my trading career, is I backtracked and I figured out, hey, I want to try to double my portfolio every year. I knew the power. Somebody had presented to me that thing where they're like, "Hey, what happens if you double a penny over 30 days in a month?" And I said to myself, "Man, some of these people talking to me in the 90s are talking about doubling their portfolio in a day. That sounds great and all, but I'd be happy doubling it in a year." Which, at the time I was earning maybe 3 or 4%. So doubling it in a year, I said, man, in 10 years, 20 years, I'd be in a place. And guess what? 25 years later, I am in a good place. So the key is you focus on 6%. That's really what I'm trying to do on a monthly basis is 6%. Now, I'll be honest, my folks that are in my program and I do way better than 6% every month. And so we wind up doubling our portfolios more than once a year. But the scoop is we want to, have a target where we can get to the moon. If we get to the stars, great. So what am I actually investing in? Well, I'm selling theta decay optimized option premium. Now, AJ Brown, that is a lot of word salad, especially if I'm not familiar or have only heard of some of these terms. What the heck are you talking about? Well, I'm profiting on time passing by. Remember, a lot of people think of options as just leveraging instruments where you can replace an underlying stock, an ETF, an index, nowadays even more than that, with some sort of derivative and get kind of a turbocharged move in both directions for you and against you. But they forget that option prices are also quite influenced by time passing by. Sometimes people call them wasting assets because as time goes by, their extrinsic or premium or time value, whatever you want to call it, goes down. And in fact, it speeds up as it gets closer to expiration. Also, options are heavily influenced by whether there is fear, uncertainty, and confusion in the markets versus confidence, right? A lot of people come to me and say, "Hey, AJ, you've been dealing in options for almost 30 years now. Aren't these suckers risky?" Well, I think of it the way that big money traders think of it. If you think about it, if you're into stocks, commodities, ETFs, indexes, Forex, whatever you're into, if you're into antique cars, you really have one mechanism to profit, don't you? You have to buy low, sell high. One mechanism, right? Some of these markets, thanks to the ability to short, you have two mechanisms, right? You can sell to open higher and then buy to close lower, and then you make money. So you have two mechanisms. But with options, I mean, you can make money going up, you can make money going down. As I mentioned, I like to focus on making money time going by. You can make money if all of a sudden there is fear or confidence in the markets. In fact, mathematicians say with all the different combinations of option strategies, as well as just selecting the different strike prices and expiration dates on individual single leg options, there's about 27 different ways to profit with options. So I really was turned on about that in the 90s when I first started learning, because I wanted to have a full tool bag to be able to profit on whatever the market handed me. And also, I've always been focused on being kind of an end of day part-time trader. It wasn't until 2005 that I had grown my portfolio big enough that I felt comfortable leaving my day job behind. I worked at Hewlett Packard that whole time, and I had to trade in the evening. So I was an end of day trader. I still am an end of day trader, but I've kind of traded in that job that I had. Now I'm in my early 50s, and guess what? I have a toddler. So I like spending every minute I can with this toddler. I also have a foundation that I started, and I like to spend all my time doing that kind of stuff, playing outside, all that good stuff. So I'm still an end of day trader who just has a very big tool chest. So if that appeals to you, having a lot of free extra time in your life, whether it's to support a career or a job, or whether it's to do other fun stuff, then this is what I do, right? How do I sell premium? So there's 4 simple transactions that I really focus on. There's a basic covered call. I'm not talking about covered calls today, but that one works pretty well, especially if the market moves up. There's covered puts, which not as many people know about, and that is what I'm going to be talking about today. That's flipping the covered call upside down. So if you've heard about covered puts, writing them, but you're not quite familiar, right? You never did the deep dive on it. Maybe you want to make sure you take some notes, right? We're also interested in doing the bull call diagonal debit spread, which is kind of the nerd term for writing covered calls against leaps, like supercharging those covered call writings using a little bit of option leverage. And I'm also going to be talking about today this 4th one, the bear put diagonal debit spread. These are going to take our covered puts and supercharge them, right, by writing them against leaps. And I want you to take note of these 4 transactions I put on the screen. Most of them can be done in a cash account, right? The covered calls, the covered calls against leaps, and the covered puts against leaps. This guy, that because you have to start off by shorting a stock, you're going to need a margin account to do this guy. But what's nice is if you don't have a margin account, guess what? You can do the same, pattern, trade the same pattern by doing the last one, the bear put diagonal debit spread. Let's talk about that a little bit more. Let's take an example. Anybody heard of Carnival Cruise Line? Carnival Cruise Line. Anybody hear of them? They're popular in a bunch of different ways. Oh gosh, I just noticed you guys have a hand raising button. If you want, click that hand raising button to see. That's a great way to interact with me as I'm presenting. And if you have questions, I might be able to get to them at the end. I got to watch my time though. So, all right. I prepared my slides yesterday. So I used end of day pricing yesterday. Yesterday, Carnival Cruise Line ended at 1939. So what if we short some shares of Carnival Cruise Line? That means we borrow shares from our broker and sell to open them, right? We get that credit of $19.39 up front, and we have a chit in the bank, basically, right? We have a chit with our broker. We owe them those stock shares back at some point. So our goal is to buy those stock shares back at a lower price give the stock shares back to the broker so we don't have them, hovering over us with that chit, and make a difference. That's the whole idea behind shorting. So short the stock, and then what if we immediately then sold a put option, which we can. By shorting the stock, we now have what's necessary to cover shorting a put option. So this is a little bit different than writing a covered call. We're writing a covered put. So if I would have shorted the $19 put yesterday, you get 68 cents of credit, right? Cool. Because options are sold in lots of 100, we would have to sell them in contracts. So for every contract sold, I just made 68 bucks, right? I call it an instant dividend. The other thing is it actually, I got a credit for shorting the stocks, 1939, showed up in my account along with that chit. And then I got an additional 68 cents. So it kind of raised my break-even price, because now I could, well, you get the idea. So what happens if CCL closes below $19 on April 17th, right? If it goes below that strike price of that option I sold, well, okay, I got the 1939 credit. If I get put to versus called out, if I get put to those shares at $19, then I can give those shares back to the broker, relieve my obligation with them. I call my obligation a chit. So if you didn't pick up on that, my obligation with the broker is a chit. So I relieve my obligation by giving them the stock shares, and I just walked away with the difference, 39 cents per share. Plus, don't forget, my voice just went up an octave. Plus, I get that 68 cents up front from selling the put option. So I've made $1.07. God, it's April 2nd. Yesterday was April 1st. I just made 5.3% ROI. Not bad for just a couple of weeks being in that transaction. But what if it goes flat? And that's actually, this is my ideal situation, is if this thing goes flat. Well, I got the 1939 credit. I have the obligation of the broker to return those shares at some point. I got the 68-cent credit. I keep the 68-cent credit because unless I'm closing below $19, if it's staying around 1939, it's not going to get put to, it's not going to get exercised. So I keep the 68 cents. That option expires worthless. I've made 3.4% ROI so far, and I can do it again and again and again. This is actually my ideal scenario, right? Because I want to set up the initial covering position just once, and then for multiple months, keep selling premium against it. And what if CCL goes against us? In this case, going against us means the underlying stock goes up in price. Well, that's okay. Don't forget, I got 2 credits, right? I got the credit for selling CCL, and then I have the obligation to return the stock shares at some point. And I got this additional credit. My break-even price is now even higher, right? I've got even more. So when I buy to close it, I don't have to buy to close it below 1939 to make a profit. I now have to buy to close at a much higher price. That means there's a built-in profit buffer of 68 cents before this trade even goes into the red. Now, I've got an additional piece to this puzzle that I'm going to talk about in a few minutes that's going to reduce our risk on return even further. But what's beautiful is there's already a profit buffer of, gosh, about 5% built into this trading strategy. So that's kind of cool. Now, before I go further, I got to show you one of my trades. I'm just going to bring up some charting software. I use Thinkorswim a lot of times for my charting software. So let's bring up Carnival Cruise Lines here. I just want to show you this chart. So, I like to leg into my position. That means I do the initial covering position on a different date that I sell my premium. So you'll see that in my trade log. But you'll notice that, we got into our position, and then Carnival Cruise Lines did go against my initial position there, And let's just take a look at what happened here. Oh, no, not Carnival Cruise Lines. I'm showing, I apologize, American Airlines. That's the one I want to show you. I'm going to show you Carnival Cruise Lines in a second, but American Airlines, let's take a look at this. So you'll notice American Airlines dipped and then stayed low. I got exercised. Now, again, that's not my ideal case. My ideal case is to be able to do it month in and month out. But let's run through. So on February 13th, I shorted the stock. I got $15.77 for 600 shares, came out to just under a $10,000 investment. And then a few days, actually a month later, I saw that it was the perfect opportunity in order to sell premium. I sold, let's make this a little bit bigger so you can see what I'm talking about. There we go. I sold the March 21 expiration, not $12.82. $12. I don't know what that 82 is. It's a typo. Let me just fix that really quick. There it is. Sometimes I do typos. There. My $12 put, and I went ahead and sold that for 76 cents. And then I got exercised at $12. That means put 2. So I was in it initially at $15.77. I got $12 plus I got the additional 76 cents, which made me a 37.6% ROI on this trade. Not bad. So instead of just selling this thing outright, I sold the premium, waited a few extra days, and sure enough, I got not only my selling price of $12, but I got the additional 76 cents. That additional 76 cents isn't something to sneeze at when your break-even price is $15.77 to start. So it just kind of supercharged my trade, didn't it? So that's a real life example of what we're talking about. So just in your mind, or you could, type some of this in if you want. I see the Q&A is open. Answer all that apply. What does investing by selling premium create? An instant dividend? Does it create a discount on a security? A profit buffer? Does it act like an expiring coupon? What do you think? What do you think? And I said answer all that apply. And the reason I said that is because all the answers are true. Let me go ahead and just introduce myself just for a second, because I'm sure well, let me ask you to raise your hand because I can skip these slides too. How many of you with a show of hands have heard of me before? Do I need to tell you guys who I am? Okay, let me ask the other question. I'm gonna put your hands out. How many of you with the show of hands have no clue who I am? Just raise your virtual hand raising button there. Here, just as a little bit of a history, when I started in the late 90s, I totally lost big, right? In fact, I have quite a few degrees that I never actually even used. I have 2 engineering degrees and a master's of engineering, right? Mechanical and electrical were my focuses. But I then went into commercial business. I went into marketing with Hewlett Packard, all that good stuff. So when I picked up trading, I mean, this was totally new to me around 1996, 1997, and I lost big. I spent more on seminars that first year. And back then they didn't really have, like we do now, webinars. You had to go, you guys might remember, you'd go on a Saturday for like a half day. And then on Sunday, you'd come back, you'd pay like $500. You come back for the whole day on Sunday to get a little bit more. And the next thing you know, you paid a couple of grand and you were on an airplane and you're going to go spend 3 or 4 days someplace. I spent $27K on those seminars. That was more than my first degree from University of Virginia. And then on top of that, I gave back $85,000 to the market. That's stupid. That first year making stupid investments. This is the code. You might want to write this down. This is the code. Number 1, make sure you stop chasing shiny objects. Don't do like I did. You want to settle on one type of investing and learn it well. And one of the things I recommend is look at your lifestyle. When I sat down and looked at my lifestyle and realized I had to be an end of day trader, and I wanted to be able to trade whatever patterns. At the time, we were having the dot-com boom, so I wanted to make money on the market going up. And then I shortly was in the dot-com bust. I needed to make money when the market was going down. So options investing end of day was perfect for me. But figure out what your life can handle, not in the future, not in your dreams, but right now, and focus on that type of investing. But don't get distracted by like Forex this day and binary options another day or crypto another day. Just pick one. You could be an expert at at any of them. Just stick with it, right? Number two, here's something I really had. Hire a mentor who isn't just talking about what you want to do, but is doing what you want to do. And most importantly, knows how to teach. I hired so many people along the way that I knew they were successful. They were showing me their snapshots of their portfolio, and I was part of trading rooms, but man, they could not convey information to me in a way that I could learn from. So it was like wasted money. So that's in the teaching world, that's called learning from guided discovery versus trial and error. If I would have learned from guided discovery, it wouldn't have taken me 4 or 5 years to get to a point where I could start thinking about leaving my day job, which I didn't do for almost 9 years. I kept going with my day job, so I didn't have to dip into my portfolio, and I could just let it grow. But if I was not doing trial and error, if I was doing guided discovery, man, I could get that down to probably weeks or months. Join an investment group. So this is what I learned at Hewlett Packard. We used to buy people's printers like Epson and Canon, and our engineers would take them apart, figure out how they all worked, and then we would like add one feature or benefit to those printers and then put our name on it and sell it. That's how the printer world worked. That's how lasers, and we may have had the patent to bubble jet and laser jet, but at the point I joined the company, we were doing this incremental improvement on our competitors' stuff. That's what they're not your competitors, right? And I don't know why they're already. My toddler is 3 years old, so I guess she's not technically a toddler anymore. She's a little girl. I don't understand why they're already telling her to not look over other people's shoulders, right? They're telling her not to. That's how the world works. That's how we improve. That's how, as a society, we get better and better. And that's what I suggest you do. Don't just join an investment group to talk about your trades. I mean, you could just, go talk in the bathroom mirror and to hear yourself talk. Listen to the other people. And if they're doing good trades, leverage with pride. Do that trade too, even if it's just in a paper trading log. Last but not least, surround yourself with like-minded investors. That's another mistake I made. I was taking advice from people who had never option traded before. Every time I had a bad trade, especially, friends at HP, they were like, dude, why do you do that? Well, those negative, words really screwed with me. And I would ask myself, and I would wind up in a bubble. You want people who are like, yeah, you had a bad day in the trading world. Tomorrow is going to be an awesome day. And not only would they be able to, deal with when you wanted to go under the covers and not come back, but they'd also celebrate with you when you had great days. So take note of these 4 little pieces here, because this is exactly what I did. I told you about my foundation. This is what I like to be remembered for, is how I've taken historically underserved inner city kids off the streets. I teach them the same exact program that I teach my paying customers. Last year, we've been doing this since 2003. We did have to take a break over the pandemic, but last year we graduated over 100 folks out of our program out of the south side of Chicago, which is kind of a rough area. So we actually graduate 106 kids. So if I can work with these kids, I'm sure I can work with anybody, right? 6-month program. It's very cool. write this down. And sadly, I didn't give this link to the folks at Festival of Traders, but this is just a way if you want to go download some of my free stuff. There's free indicators that I've created on all the different platforms. You can get a free workshop on premium selling. You've got, I've got a new options lookup tool that I'm just giving away for free. I give so much stuff for free. You can follow us on our YouTube. It's called links.tte4.me. So if you wanted to visit it and, you know, click on those things and check me out, I would love for you to do that. Okay, let's get back to, I want to lower our investment. I want to increase our returns, and I want to be able to do the same patterns but not need a margin account. What do I want to do? Should I sell out in time options? Like instead of selling 1 month options, sell options that expire 2 months out? Should I replace the security with options trading at parity? Should I give up on all this and start buying mutual funds, or is what I'm talking about not even possible? What do you think? A, B, C, or D? If you're thinking B, replace the security with options trading at parity, that's what we're going to do. So what are these options trading at parity? Well, option premium is the most when the option is at the money. So that's why when we are selling premium, we want to sell near term at the money options. When we go deep in the money, the option actually changes its characteristics. I like to target less than 5% extrinsic or premium value. It's almost completely in the money. That means it gets tied to the stock dollar for dollar, right? To get rid of all the word salad, a deep in the money option behaves exactly like the underlying symbol, dollar for dollar. So if the underlying symbol moves a dollar, so does the deep in the money option. And what's neat, we're talking about puts today, they move opposite, right? But they do it at a cheaper price. So remember we talked about Carnival Cruise Line. If we shorted it, that means borrowing it from the broker and, you know, having that chit with the broker. The option is for a little more than half the price, I could buy a substitute option. The Carnival Cruise Line expires out in January of 2026, $30 put. This particular option that I would choose as a substitute has only 2.7% premium value. The rest of it is 1-to-1. So if Carnival Cruise Line goes down $1, this option is going to go up $1, right? The put operates opposite, but the key is it's going to move dollar for dollar. So instead of having to short a stock, in this case, I'm buying this put option. And then, of course, I'm selling that put premium. I'm getting that instant dividend. So what happens? Well, if I get called out, so this is where it's called a spread. If I get not called out, but put 2, if I get put 2, I get the difference between the two strike prices, the 30 and the 19. I get $11. So I make 10 cents per share profit, but don't forget, I also made the 68 cents. So that's 78 cents of total profit, or a 7.6% ROI. What if it goes flat? That means I get to keep the 68 cents and do it again and again. And what if it goes up against me? I have that built-in profit buffer of 68 cents. Now's when I'm going to show you my Carnival Cruise Line trade. So on February 28th, I went ahead and bought the substitute option. I paid $7.70. On March 14th, so about 2 weeks later, I sold the premium for $1. That premium on March 21st expired worthless. So I did it again today, just a few hours ago, a couple hours ago, to be honest. I made 98 cents. Now, I'm still in this position, but if I was theoretically to get exercised at that $20 put, right? And my initial covering position is the $30 put, which means I would make the $10 difference. I'd be walking away with 55.2% right now. We're going to see how it plays out on the third Friday of April. By the way, you might have noticed that these monthly options always expire on the third Friday of the month. Third Friday of the month is payday. If you're using weekly options, it's every Friday, right? All right, here's the last piece of the puzzle, right on time. I got 25% of my presentation. How can we drastically reduce our return on risk? What do you think? Should we sell half as much option premium? Should we sell farther out in time options? Should we collar the investment by marrying a protective option? Or is, again, what we're doing not even possible? Here's what we're going to do. We're going to collar the investment by marrying a protective option. I'm just going to show you a real trade here. Actually, it's on Wendy's, WEN. So here's the chart. I like these sideways choppy moving stocks, by the way. Those are the ones that allow me to sell premium against them all the time. So here, I shorted Wendy's, and then I sold the premium and bought, in this case, a protective call. So the premium I shorted, or I wrote, was the near term at the money. The protective option, I go 3 to 6 months out, and usually around the break-even price. So in this case, I was $17.66. I used the $17 protective option. So here's how the economics worked out. I made a 31-cent credit, and then I had to spend 20 cents on insurance. But because I sold the premium and bought the protection on the same day, which is kind of when you want to do it, because the protection is most important to have on when you've sold premium. The third Friday of February rolled around. This 31 cents expired worthless. And guess what? I waited for my trade signal to come up. And on February 26th, a few days, this was a Friday, this was, I think, a Tuesday, I sold that protection. I didn't need it anymore. Not only was I able to have protection from January 24th until February 26th, protecting my trade, but when I sold it for more money than I bought it for. In other words, I made kind of some frosting on the cake. So in addition to making 31 cents, I made another 18 cents, right? The difference between what I paid for it and what I sold it for. I did it again, March 6th. I sold premium. This time I got 50 cents. I bought protection. This time it cost 25 cents. March 21st rolled around. The premium expired worthless. I got to keep all 50 cents. This time when I bought back the insurance, I paid the same price. But check it out. I had it from March 6th to March 21st, and it cost me nothing, right? Right now, I'm looking for the best opportunity to do this a third time. Sell premium, buy protection. But if I was to buy to close Wendy's, and again, this is yesterday's end of day price for $14.72, look at the difference. In other words, I shorted it for $17.66. I could buy to close it for $14.72 and walk away with a pretty massive profit, and the whole time I was protected. Pretty cool, right? This is the graph that shows it doesn't really matter if, most of our positions last about 5 months before they get exercised. So it's the time passing by, because if the underlying symbol goes for you versus against you, you still make if you let enough time go by. And notice as you let more time go by, it gets exponentially better. You still make money in either directions. People like to ask me, what's your win-loss ratio? Well, the scoop is it's more about time, right? You can see here that this trade becomes totally risk-free, meaning it's only the dealer's money so long as I get in there for at least one cycle of selling premium. Let me get to the 3 steps. So you might want to write these down. Buy or short an underlying security. Buy a substitute option trading at parity. That's step one. Sell a near-term at-the-money option for its premium value. Collect that instant dividend, have that profit buffer. Collar with a married option that is 3 to 6 months out in expiration to protect your investment. We talked a lot about the covered put today. So you noticed I went in on different dates. So you find one of these sideways choppy stocks, you short the stock or you buy the option trading at parity, the put option trading at parity when you're at a top in the channel. At the bottom is when you sell near-term put option and buy your protective call option. The put option expires worthless. You roll out the call option, rinse and repeat, rinse and repeat. I'm going to just fast forward a little bit past a lot of this. This is talking about, and like I said, I didn't really want to make a big deal about my offer. I just want you to know that should you come work with me, we've got video tutorials to get this going. It usually takes about 1 to 2 weeks. You know, if you do a video every evening, everything I do is tailored towards people doing this in the evening. Then we have monthly live classes and their replays going all the way back to 2010. I've actually been running this premium selling program since 2007. I have screeners to help us find the best candidates for the underlying symbols. Plenty of planning tools so we get our risk management down and know exactly what to do and when. And this is what a lot of people like. They like my live workshops. Every Thursday, my program participants and I get together and we work out one of these trades, the whole trade plan. And then our folks go and either paper trade or real money trade it. And a lot of people are like, hey, AJ, or I'm like, hey, why do you keep coming back at the end of the program and signing up again? And that's because they like these workshops where I just hand them trades. There's also trade review. If you do your own trade planning, I like to look over your shoulder. We have a double your money back guarantee. I'm going to give you, as being part of Festival Traders, a discussion with one of our coaches, a free session with one of our coaches. So what is all of that worth to you if you think about all the stuff in our program? Because if you go on my website, you'll see that we charge $5.97. Now, this is a flat fee. You're not going to get charged again. We're not going to ask to, renew you, put on a subscription. It's for 6 months of access, no other charges. And because you're part of Festival of Traders, we're knocking down $100. All you have to do is go to optioninvesting.org/FOT. And I want to just test this because I didn't get a chance. Here it is, optioninvesting.org/FOT. There's a promo code place, and this is also 100 capital DISC. Let me just make sure it works. Whew. So there's the $4.97 price tag for 6 months. I don't think it's going to take you 6 months. I think that it's going to take you a couple of weeks, but I want you to be part of those free where we give you a trade every Thursday, and I want to look over your shoulder for 6 whole months. That's what I do with my inner city kids. That's what I want to do with you. And so this is my offer. Please take it. If you have any questions, by the way, you're welcome to give us a call. And that's the end of my presentation.